Hello and welcome to the Weekly Outlook at XM.com. I'm Maria Pachorvis, and joining me is Senior Investment Analyst Rafi Boyadjian. We'll be reviewing the week ahead. So Rafi, we'll start the week on Monday with fourth quarter GDP figures out of Japan. During the third quarter, there was a rebound in the economy. Are we expecting to see an extension of that rebound this time around? And what about the reaction in the yen?
So Maria, that is right. So we did see a strong rebound in the previous quarter, and in the fourth quarter, it's likely the economy grew by 2.3% on a quarterly basis. So that's a pretty solid number considering how badly other countries did in the fourth quarter, particularly in Europe. So although Japan did see a bit of a resurgence in virus cases from November onwards, and we do have state of emergency in several regions, we don't have full lockdowns in Japan like we have in Europe. So although consumer spending might have been dampened, on the whole, exports have been rebounding quite strongly. And pretty much the case is that as long as we see the US and China doing fairly well, then Japan should avoid going into double-dip recession. Now, looking at the yen, though, the yen has been weakening against the likes of the euro and the pound, and even against the yen this year since January. That's because we're seeing, of course, a receding safe haven demand. So even though the economy should perform fairly strongly this year, that's not going to be reflected in the yen because, of course, the yen pretty much remains a safe haven play.
Australia also seems to be doing fairly well in terms of its recovery. We'll get the jobs report on Thursday. What should we look out for there?
So there's been sluggish progress in the labor market in Australia since the fourth quarter, and that's not expected to have changed much in January. We're expecting a rebound of just 40,000 new jobs. The jobless rate will probably fall to about 6.5%, so that's still well above pre-pandemic levels. So as long as the jobless rate holds significantly above pre-pandemic levels, the RBA will remain very much dovish, and we could yet see even more, additional bond purchases from the RBA later this year if the recovery in the labor market remains sluggish. We did get that surprise boost to QE, the last meeting from the RBA. So although the Australian dollar is being boosted by the persisting risk appetite we have in the marketplace, its gains might be capped by that fear of yet more QE from the RBA.
Okay, moving on to the EU and the UK now. Both the European economy and Britain's economy are struggling due to the ongoing lockdowns. But there's hope, at least in the UK, that their rapid vaccine rollout will help put an end to the virus restrictions. We'll get a slew of data next week. What's expected to attract attention, and what's the outlook for both the euro and the pound?
So the focus will pretty much be on those flash PMIs for February in both the Eurozone and the UK. Now, the Eurozone numbers will probably be slightly better because some countries in the Euro area did ease their restrictions slightly. The UK, on the other hand, has remained under a hard lockdown. So the UK numbers will be pretty bad. We're also going to have retail sales numbers as well out of the UK. Those aren't expected to be much better either. On the other hand, looking at the currencies, the euro's direction will pretty much depend on what happens to the dollar, because as far as the outlook is concerned for the euro, it is rather concerning given, as you mentioned, with what's happening with the vaccine situation. The UK's outlook is looking much better, and so that trend will probably continue. But nevertheless, given the pound, how much the pound has gained in recent weeks, we could see perhaps a bit of a correction if we were to get a really big miss in the UK numbers, particularly retail sales and the PMIs.
And finally, in the US, there was a modest rebound in January in non-farm payrolls. What are the forecasts for the upcoming retail sales data? And what will investors be watching out for when the FOMC minutes from January's meeting come out on Wednesday?
So the retail sales data will be the highlight really on the US calendar, even though we do have plenty of other data coming up. So we did see pretty poor numbers for November and December for US retail sales. And now in January, we are expecting a bit of a boost coming through from those stimulus payments. Of course, we had that $900 billion stimulus package in December, and that included $600 payments for all Americans. So that should have boosted consumption. How much, though, that remains to be seen. Forecasts are for 0.7% monthly rebound in retail sales. If you get a bigger surprise, positive surprise than that, that could potentially boost the US dollar. On the whole, though, the US releases aren't expected to change the economic picture much, so investors might turn their attention to the FOMC minutes that are due on Wednesday. Now, we have seen fairly dovish remarks from Jerome Powell lately, and other policymakers have also been trying to push back on suggestions that the Fed might begin to taper its asset purchases sooner than expected. So if the minutes do underscore that view that the Fed is in no rush to begin even discussing withdrawing some of the stimulus, then that could be negative for the dollar. On the other hand, the general meeting did come after those Georgia runoffs, when pretty much confirmed Democrats are now in control of both houses in Congress. So that pretty much guarantees big spending on the way. So we could perhaps see some apprehension from some FOMC members about keeping the stimulus taps wide open for an unlimited period of time. So any contradiction to that dovish view might possibly upset markets. So really, it's a two-way risk for the dollar from the minutes.
Rafi, thanks so much. And thanks for joining us at XM.com.